Foreign portfolio investors have pulled $49 billion straight out of India since 2024. Meanwhile, the United States just absorbed over $1 trillion. Global capital is actively bailing on traditional emerging markets and hyper-focusing into American AI infrastructure. While digital capital is flowing at speeds we've rarely seen, physical commodities are facing massive bottlenecks. A paralyzed geopolitical choke point in West Asia is squeezing global shipping lanes, leaving traditional manufacturing economies incredibly vulnerable to sudden energy disruptions. This combination of digital flight and physical paralysis creates a high-pressure environment where the traditional buy-and-hold strategy for emerging markets is becoming a liability. Navigating this requires moving away from broad indices and towards specific tactical pockets of the economy. Global liquidity is acting as a massive vacuum right now. Because these shifts are happening at such high velocity, being caught on the wrong side of this wealth transfer risks significant and rapid portfolio destruction. Through early 2026, the United States and Iran dialed up pressure in West Asia, pushing regional security right to the brink. But as strategic energy buffers in Western economies neared depletion, pure economics acted as a forcing function. Both sides had to swerve, resulting in a 60-day truce signed at Versailles on June 18th. This chart shows the immediate economic relief valve of that agreement. You can see Brent crude climbing to a peak of $120 per barrel in April, before plummeting down to $79. But the underlying physical reality is still a mess. Iran laid roughly 80 naval mines right in the center of the Strait of Hormuz, effectively closing down the main deepwater highway. Operators are now forced to navigate narrow coastal paths near the Yemeni shore, dealing with strict single-use permits and 48-hour advanced transit registrations. The core issue has just been deferred. While a paper contract brought a temporary dip in crude prices, physical shipping remains restricted. That logistical nightmare keeps global energy costs heavily exposed to the next disruption. At the exact same time commodities are hitting these physical choke points, global liquidity is consolidating. The United States, alongside semiconductor-heavy markets like South Korea and Taiwan, is acting to finance a massive AI hardware infrastructure boom. This is a chart of the Shiller-Cap ratio, which smooths out corporate earnings over a 10-year cycle to show current valuation levels. Right now, it is sitting at 42.0x. The 140-year average is just 17.0x. We haven't seen valuations this high since the absolute peak of the dot-com bubble, when it hit 44.0x. And the pressure on traditional markets is set to intensify. We have 3 frontier AI mega listings coming up: SpaceX, OpenAI, and Anthropic. Together, they are expected to bring a combined $3.75 trillion of market cap directly to the public markets. Global investable indices represent a fixed pie. Adding nearly 4% of weight from U.S. tech means passive index funds will be forced on autopilot to rebalance. They will mechanically sell off their emerging market holdings just to make room for these behemoths. Emerging markets aren't just losing investor appeal. They are facing a mechanical, automated capital eviction as index funds shift their weights toward the American AI sector. When you take expensive, volatile oil and rapidly fleeing capital and crash them into a domestic economy like India's, you trigger a synchronized cyclical slowdown. This chart shows exactly how that pressure translates. You have surging wholesale prices hitting 9.7% due to high energy and metal costs, sitting against weak consumer inflation at just 3.9%. That creates a 5.7% gap. That gap is a massive margin squeeze. Manufacturing and industrial companies are paying more for their raw materials, but they can't pass those costs on because retail consumers are completely tapped out. Companies are forced to eat the costs themselves, driving down profit projections across multiple sectors. Adding to the stress, a confirmed Super El Niño is currently threatening the rural economy. The Meteorological Department just dropped its monsoon forecast to the weakest projection we've seen in 11 years. With a 60% probability of deficient rainfall, the vital autumn harvest, which makes up half the nation's agricultural output, is at risk. When the rural harvest suffers, mass consumer confidence and spending plummet. Traditional domestic businesses are caught in a trap between skyrocketing global supply costs and a deteriorating domestic consumer base. A slowing, squeezed economy requires a very specific approach. Shifting interest rates and fuel prices create isolated, highly profitable winners if you focus on the mechanics of their operations. Take the financial sector. Non-banking financial companies, your vehicle and consumer lenders, have asset books locked into fixed rates. They can't charge customers more, but the cost for them to borrow money is surging. Conversely, private commercial banks tie a large chunk of their loans to external benchmarks. As market yields harden, they can raise rates on borrowers, protecting their profit margins. On the consumer side, sky-high petrol prices are rewiring the math of the family budget. If you drive 15,000 kilometers a year, a traditional car costs nearly 15,000 rupees a month to run. An electric vehicle costs barely over 2,200 rupees. That effectively grants an EV owner over 12,000 rupees in monthly cash savings. That monthly savings cuts the payback period for an EV down to just 39.5 months, pushing the consumer economics to a tipping point.